Good day, ladies and gentlemen, and welcome to our class on RSI, one of the most popular indicators in the trading markets. Now, I would appreciate it greatly if you could subscribe to my YouTube channel by just clicking the bell icon down below or the subscribe button. I promise you we're not going to bother you with anything. You'll get a ping from YouTube whenever I upload a new video. So let's get started talking about RSI, Relative Strength Index. It is one of the best oscillators that we can combine into a trading system. Whether it works great with MACD, it works great with Bollinger Bands, it is one of the most popular and well-used indicators in the marketplace. Now, the Relative Strength Index is a momentum indicator. It was developed by Wales Wilder and was published in his book in 1978. Now remember, in 1978, there was no online trading. There was really no retail trading and investing at all. And we didn't have computers. Well, we might have had computers. Those great big computers that took up a whole room full of air conditioning. But we didn't have Windows. We didn't have PCs. We didn't have the internet. Now, RSI is primarily used to identify overbought and oversold conditions when trading an instrument. So, primarily, RSI was developed for a slower moving market and for primarily the stock market. But over time, it's been adjusted and adapted and works great in short-term markets, on short-term charts, and in Forex and cryptocurrency and CFD trading. Now, as you can see here, RSI is placed on the bottom of our chart, below the price action. Now, RSI falls into a class known as an oscillator. In fact, it's called a bounded oscillator because every time you calculate it, it will come out to a numeric value between 0 and 100. So it's got boundaries of 0 and 100. Now we also have boundaries that are placed on the chart because RSI above 75 or below 25 tells us something. Now, we have traders who use 70-30, we have traders who use 80-20, but that's an individual decision. So RSI is considered overbought when above 70 and oversold when below 30. Now, please don't mix up overbought and oversold with buy and sell. An overbought market can remain overbought for quite some time, and an oversold market can remain oversold for quite some time. Signals can also be used to generate by looking at divergence, failure swings, and centerline crossings. RSI can be used to identify a general trend. Now, the calculation for RSI isn't quite difficult. It's not a great big long mathematical calculation like Bollinger Bands using standard deviation. RSI is pretty straightforward. Now, you'll never have to calculate it. But RSI is equal to 100 minus 100 divided by 1 plus RS. And RS is for the average number of days when the instrument closed up or closed down. So to simplify the calculation, explain RSI has been broken down into two basic components. RS, which gives you the average gain and the average loss. The RSI calculation is based on 14 periods, whether it's 14 1 hours, 14 15-minute closes, 14 days, which is the default suggested by Wilder. Losses are expressed as positive values, not negative values, because what we're calculating is the difference or the sum of the gains or the losses, but not added together. So the first average gain is the sum of the gains over the 14 periods. So that's only the days that it closed up. And then the average loss is the sum of the losses over the 14-day period. And the second and subsequent calculations are based on the prior averages of the gain, the current gain and loss. So what you would do is you would take the previous days, just like you do with moving average. You take the gain or the loss for the previous day, and you would subtract the farthest day away from it, and then you'd add today's gain or loss, whichever it might be. So taking the prior value plus the current value is a smoothing technique used in calculating an exponential moving average. This means that RSI values become more accurate as the calculation periods extends. Advanced charts use at least 250 data points prior to the starting day of any chart, assuming that that data must exist when calculating its RSI values. To exactly replicate the RSI number, a formula will need at least 250 data points. That's because you have to use the open, the high, the low, and the closed, and calculate the losses going back over 14 periods. So the default look-back period for RSI is 14. Now, there's some people who use 10-day. There's some people who use 20-day. That's up to you. I always use the default look-back periods because otherwise none of the information I'm reading and all the research that everybody else has done and all the testing everybody else becomes invalid. And I have to start using everything based on my calculations of the customized, personalized 10-day, 12-day, 16-day. Now, the look-back period also depends on a security's volatility. RSI on a 14-day for Amazon is more likely to become overbought and oversold than a 14-day for RSI Duke Energy, because it's slowing. When you have especially a stock that's moving very, very slowly and hardly moves up or down and gains very little, it doesn't have any volatility, so the RSI wouldn't change much. So you might want to shorten that look-back period. Now, once you've done your calculations and dropped it on your chart, it's easy to do. So RSI is considered overbought when above 70 and when below 30. Now, some people raise overbought to 80 or lower oversold to 20 and will reduce the number of overbought and oversold signals. Short-term traders sometimes use 2-period RSIs to look for overbought readings above 80 and oversold readings below 20. You can. In other words, like I said, you can customize it to be any which way you want. But then you can't use any of the research anybody else has done. You have to find research that was done with the same periods that you're using. Now, since RSI measures the relative strength of the underlying market, it's a technical tool that can be applied to any market. However, it is commonly applied to more liquid, larger markets like Forex, stocks, and commodities. Now, in a downtrend, RSI can remain oversold. And so in an uptrend, RSI can remain overbought. So a lot of times we'll use the center line. So if you have always a calculation between 0 and 100, you have your boundaries at 70 and 30 or 80 and 20, your center line is always going to be at 50 because the difference between the 0 and 100. And we can use that center line when the RSI indicator is moving upward and breaks that center line, you are probably in an uptrend. When RSI is going downward and breaks that center line, you should be in a downtrend. Now, the RSI is used in a number of ways. The three most popular ways are overbought and oversold levels, ranges, and divergence. So as we can see here on a chart, RSI is placed below. Okay, and what we want to do is we want to see the difference between see the dashed line here? That's the 0 line. We can go down below or up above, and we want to see its relationship. Plus, we can see divergence, because here we can see the RSI indicator moving downward while price is moving upward. We move through the 50 line, and then we move into overbought territory here. And as we can see, price stayed overbought for quite some time. And as price eased, it started to move back down and broke through the 50 line, and that told us that the markets were turning. So when a buy is triggered, a stop is placed below The most recent swing low. A sell signal is used to exit long trades or initiate short trades. During trends, the RSI will usually stay contained within certain readings. During an uptrend, it typically bottoms above 30 and frequently reaches 80. Now, what you have to do is you have to remember, you have to look at the RSI action for that asset. You have to know how that asset moves. If you're using RSI for Bitcoin, which moves in big gaps and moves high and low and has high volatility and high movements, you're going to apply different, not numeric values, but different interpretations than if you look at it compared to the Chinese yuan, which doesn't move much at all. So during a downtrend, a short sell-off if the price rallies above the 65 and then drops back below. Place a stop above the recent high. Cover the short position when the stock drops below 30 and rallies back above it. So you want to watch as price breaks that 30 line, as the indicator breaks that 30 and goes into oversold and then bounces back up into that range again and is back in and bounces back out, as opposed to too many people want to look at it and say, look at that, it's falling all the way down to overbought, or oversold, and they do something. You actually want to watch for the drops in and outs. So like here on this chart, you can see the price pushed up, broke above the 50 line here, the red line, and then moved up to the boundary line at 70, touched it, and then fell back into the 70. Again, here, we saw it break out of the 30, here and here, break out of the 30, and then move right back into that range. And here's how you'd want to put your stop loss and the direction that you would want to trade that asset. Now, I don't trade divergence. I hardly ever even notice it on my charts. But RSI is, people talk about trading divergence with RSI at all the times. Now, the RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong up or down, the indicator can stay in overbought and oversold territories for a long time. Therefore, price analysis or some other confirmation tool is needed for reversals. The same is true of divergence. While RSI may be dropping and price rising, that doesn't mean price will drop soon. Now, the most basic RSI application is to use it to identify areas that are potentially overbought and oversold. Movements above 70 are interpreted as indicating overbought conditions. Conversely, movements under 30 are oversold conditions. The level of 50 represents neutral market momentum and corresponds with the center line in oscillators like MACD. So that 50 line is all important because it's telling you that when it's at 50, the market's neutral. When it starts moving above 50, you should have momentum moving upward, or the beginnings of, it could be sideways, it can be congestion, but moving on a positive way, or negative. Okay. But it will help you understand and see where the trend is going. So in terms of market analysis and trading signals, RSI moving above the horizontal 30 reference level is viewed as a bullish indicator, while the RSI moving below the horizontal 70 reference level is seen as bearish. As with other momentum oscillators, overbought and oversold readings for RSI work best when prices are moving within a sideways range rather than trending up or down. So in other words, when price is trading sideways, a change in the RSI will indicate the beginnings of a trend, either up or down. Wilder suggests that divergence between an asset's price movement and RSI oscillators can signal a potential reversal. The reason is that in these instances, directional movement does not confirm price. As with overbought and oversold levels, divergences are more likely to give false signals in a context of a strong trend. Now, see, for me, I only trade trending markets. So looking for an asset to tell me a trend is starting is a little bit late for me. I want to see a confirmed trend, and I want to see support and resistance. I don't actually use indicators. I use chart pattern, support and resistance, and trend lines. And I confirm everything with volume. Now, as mentioned, in interpretation of RSI, it is a more reliable indicator in a ranging market and can give misleading signals in a trending market. However, a modified interpretation of RSI can be used in a trending market. For example, during a strong uptrend, RSI might move only between the levels of 40 and 80. In such case, RSI falling to 40 can signal a potential bullish reversal. And this is why I said to you also, you have to understand the asset class, and how that asset normally prints in RSI. Now, trend lines can be used on the RSI oscillator itself in the same way as on price charts. When traders first learn about RSI and other oscillators, they tend to gravitate towards overbought and oversold values. While these are intuitive points to enter in the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended trends can keep RSI overbought or oversold for long periods of time. So remember, the center line is also very important. All oscillators have a center line, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different, with a center line found in the middle of the range at a 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy the market. A drop below 50 would indicate development of a new bearish market trend. So watch the center line. It's crucially important. It will tell you more than that 70-30, 75-25 boundary. So the bottom line is the RSI is popular because it has multiple uses. It's used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot or confirm reversals via divergence. Like any other technical analysis tool, though, RSI is prone to providing false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. Remember, indicators only indicate. Think of them as the interpreters of the market. Okay, they're only helping you to interpret when you can't see a clear picture. So thank you very much for joining us. I hope you learned a little bit about RSI. It's a very popular indicator, and you might want to add it onto your trading in the near future. So once again, thank you very much.